Olivier Blanchard, Economic Counselor at the International Monetary Fund. In your new World Economic Outlook, you've revised the outlook a little bit downward in spite of the boost that we might have expected from falling oil prices. What's happening there? What's happening is the decline in the price of oil is, as we called it, a shot in the arm. It's very much that. It increases the real income of people, decreases costs. It's good. It's mostly for oil importers, obviously, which are very advanced economies. So that's very good. But a shot in the arm is not always enough. And on the other side, going against it is general weakness of many economies in the world. To put it more technically, potential growth, which is the growth that we can expect to see over the medium run, the years to come, it has been revised down. And this leads firms to invest less because the future is less bright, and the result is growth is lower. And it turns out that, unfortunately, the second effect is stronger than the first. So that's why we've revised down. Does Europe stand to benefit from these falling commodity prices and the lower euro? Is it enough to strengthen growth there? It's good, but it's not enough. And the decline in the price of oil, these are nearly all oil importers, is definitely good news. That's going to help. And the decline in the euro at this stage is also a very good thing. So both are going in the right direction, but unfortunately, again, the medium run, the future doesn't look as bright. Investment is weak, and so for most countries, we're revising down. Not much, but down. Now, this being said, I think we may be a bit pessimistic about the effects of the price of oil. So in the jargon of economists, there is an upside risk, which in fact, the price of oil will help more, and things will turn out better, but we can't count on it. Now, turning to emerging markets, they face a lot of risks this year. Would you say that rising interest rates is the biggest challenge that they have to contend with? In general, I think emerging market countries face two challenges. The first one is this one, which is high interest rates in the US, which are going to force them to have high interest rates in general. They are going to have tighter financial conditions. To a large extent, I think this is anticipated. This is already built in interest rates, in exchange rates. So this may not be as bad as some think. The other challenge is an internal challenge, which is that many countries are facing a decrease in potential growth. And they have to decide what to do about it. And in most cases, it means taking structural reforms. A particular example is China, which basically is trying to change its growth model, and which is a fairly major challenge for them. Now, of course, you're releasing the World Economic Outlook in Beijing. Right. How will this slowing growth in China affect the rest of the world? So the first point to make is that the slowing growth, we think, is a good thing. It basically shows that policymakers in China have decided to reduce some of the dangers that they were facing on housing, on shadow banking, are taking the right measures. They're also trying to reorient growth from investment to consumption. So all this is desirable, but it's leading to a lower growth rate. That's why our forecast is only of 6.8% for 2015, which is lower than what it was in 2014. Now, this is having an effect on the rest of the world, food trade. So Asian countries around China will have, other things equal, lower growth because they will be exporting less. We think the effect is relatively small. If you wanted a number, 1% less growth in China leads to about 0.3% less growth in Asia. It will have a small effect on the rest of the world food trade. The other channel is food commodities, which is that lower growth in China means lower commodity prices, and this is affecting countries in Latin America, which have been facing now for some time and will continue to face lower commodity prices. That's a challenge for them. Olivier Blanchard, thank you. Thank you.